Hello, everyone. Welcome to our fourth session of the Level Up Your Customer Journey webinar series. I'm so excited to be here and looking forward to a great session. So, in this webinar series, we will cover the main challenges we observe in the customer lifecycle, and for each touch point with the customers, we will discuss how a simpler IT platform can help improve the customer journey from onboarding to customer management to collections. My name is Bo Rasmussen. I'm the Chief Commercial Officer in Experian Northern Europe, and today I'm joined by my colleagues from Experian Northern Europe, Bruce Hansi, who's the Analytics Lead Nordics, and Jacob Bergman, who's the Principal Consultant in our cluster. In today's session, we will start with yet another customer touchpoint within customer management. We will cover today how organizations, by using data and analytical models in one modern technology platform or ecosystem, can actually help improve the bottom line of many companies. The key is actually to spot trouble earlier and before it hits your bottom line, because that is not where you want to go, right? So let's kick off and explore how businesses can manage customers even more effectively by unlocking the power of data. And Jacob, please kick off by explaining why this theme today is relevant and important.
Many thanks, Bo. And I just want to, in order to really set this in the right context, I really like to refer to our Forrester report that we published in the summertime. We have the QR code here on the slide if the audience is keen to download it. If you haven't done it already from the previous sessions, we've also mentioned it. In this report, we collected a lot of interesting feedback from senior decision makers in the financial service industry and telcos across many geographies. And this feedback is really, really important to address, because one of the elements that they highlighted in this report is, first of all, machine learning. But if we move to the next slide, some of the interesting feedback that we observed is that these organizations have actually seen significant volume of customers either defaulting or entering collections during the last 12 months. And that also means that increased attention has been observed in these organizations to look into how to manage vulnerable customers more effectively, because today it's challenging. We've also discussed it in the previous webinars that some of the challenges is not that organizations don't know what to do, but they can't. And that is due to the legacy systems and impact of not being able to use data insights in real life activities. And I think now we can quantify the challenges with the output of this report and really put adequate attention to what is actually needed to be done by organizations if they want to succeed managing the vulnerable customers more successfully in the future. I don't know, Bruce, any considerations or reflections from your side?
Yeah, I would like to mention that this is a very important topic, as we also see in the Forrester research we conducted this year. And in Nordics or in Northern Europe, generally the markets or the asset quality in the organizations are high quality, but we can also see that nowadays in the last periods, the vulnerable customers, or we can also call them underperforming loans, stage 2 loans, are also slightly increasing in our market. So it is showing that this issue has been in the focus of the businesses, but it is still there. So it is still to be touched or managed in the organizations. Especially after this macroeconomic distress periods following 2020, end of that year, we can see that in Sweden, Finland, maybe slightly less in Denmark, but also in Norway, we can see that this is an issue also in the books. And what is a lessons learned from that distressed macroeconomic periods is that If proactive actions are not there in place, and if they are not defined already, it is hard to identify them in the early stages, and it can impact significantly the institution's financial situation, but also it will make the customers unhappy, or they will struggle with their payments and their financial health. So this is very critical still we can see in the market. Maybe to touch base on the actions, or how this kind of vulnerability or observed underperforming is affecting the organizations, it is the cost effect we should be cautious about, because when these are not identified in a timely manner, it is creating an additional cost to the organization from provision perspective or capital requirement perspective. So if these customers are not caught in the right timing, which means that a restructuring of the loan will be needed, or a forbearance situation will occur. And this will, in any condition, if they end up in stage 2 as an underperforming loan, or if they end up in stage 3 already as a default, they will both require lifetime provisions, which means that not only for 1 year loss estimations will be done, but it will be done for the full maturity of the loan. So requiring lifetime provisions for the organization, which means that it's the higher cost to the organization. So if they would be caught up in the very early stages, they would only set aside 1 year expected losses. But now in this case, it can be easily end up with very high value of provisions that they need to set aside. So yeah, it's a bit tricky situation, we can say, to be very cautious about.
So just to be clear on the context, the lifetime provision, meaning that it's not only likelihood of defaulting the next 12 months, but it's throughout the lifetime of the customer.
Exactly. And if it is a non-performing forborne exposure, maybe a bit more technical details, but since you asked, if it would be a stage 3, or if there's a second forbearance action, which means that you are restructuring or giving a payment holiday for the second time, or even if you restructure, but they again fall into 30 days past due stage, they will again end up in stage 3. Or if your restructuring is causing a net present value change more than 1%, they will again end up in stage 3. And in any case, when they are already restructured or forborne, they will be falling into stage 2. So in any case, forbearance is creating the additional cost to the organization. So early identification is really crucial.
Fantastic.
And what about from your perspective, Jacob, maybe the regulatory aspects, because this is also something we generally discuss. How do you see that?
Yeah, definitely. And I think particularly in Denmark, last year, springtime, ledelsesbekendtgørelsen on how to define the responsibility of boards in banks was also updated and creating additional attention by banks and organizations to really focus on the management of customers in a much more structured way and in more clear governance structure. And what some of the elements I'd like to highlight here is that the credit policy must contain some principles for the management of the non-performing and forborne exposures that you just mentioned, Buse. And we suddenly saw that banks very quickly adapted to this area of focus. And I think also the clarity of responsibility has been historically vague, who's ultimately responsible for the portfolios, but now it must be detailed, so there's accountability in the organizations. And also, what are the action plans? And I will come back to that also during this webinar. How do they actually look like? So we'll just park that for a couple of minutes. But also when the NPL levels exceeds 5%, then also what needs to be done in order to reduce that is also something that has become more clearer from a regulatory perspective. So definitely, beside the provision part that's important, there's a clear regulatory push to provide much more clarity on the accountability of the organizations, which I think is very, very useful for everybody. And that also means the legacy systems must go. Something must replace them.
So that's I think that's a really good and interesting overview. So, but you speak about distressed periods, you speak about the forbearance affects NPL, you speak about higher costs to the organization, and you speak about regulatory challenges. But what can we do about this? Is there anything we can actually do about this?
Exactly. Maybe I can take it first, and Jacob, please continue with your view. So we see that in our conversations with our clients, but also with our experience and knowledge on this area, the solution is early warning systems. It means that you need to proactively approach these clients, but how to know which ones to approach? So you need some early warnings, some alerts that will give you this overview of your customer situation and be there for them in the early stages of their struggling in their payments. So if you have a well-designed early warning system, it will reduce the cost of defaults. We mentioned to that one. So lifetime provisions, high-level capital, it is creating a cost for the organization. So if you can avoid them, the cost will also be decreasing. Cost of collections, this is another aspect. So if they end up in later stages in the collections, the cost of collections are also increasing. So debt collection agencies, more people to work on the cases. It is also tricky. And it is also increasing the loss of valuable customers if you don't have an early warning system, because when they are struggling, if you are not there, if you are not approaching them on the right time, they can, of course, go to another competitor or where they are feeling better treated. So the key wins from an early warning system is default prevention, increasing the efficiency in these processes. And also, Jacob, you mentioned the regulatory aspect. It is also to fill in this gap in the compliance goals, let's say.
Yeah.
Just a little brief intro.
Yeah,
but,
exactly.
How do you see that?
Yeah, and my best way of understanding issues is to look into a micro scenario. In the previous webinar, we met Jens, whom we see here on this slide. And Jens, those in the audience who...
He also looks a bit concerned.
Yes, and Jens is still struggling with his payments. On his payments, he has some employment challenges. He's now 32 days past due. Meaning that he's now stage 2. We need to look into a lifetime PD. And he's at a medium balance at risk. And this type of scenario is not an uncommon situation for banks. But the key question, what to do? And the question is not to a case handler to do that manually, but what should the system suggest? And here we need to look into it in a different way. And if we move to the next slide, I'll briefly start on some of the triggers that we see can be used by organizations in a data-driven way. The first early trigger we see is the customer loses job or similar. The bank is not notified that the person is maybe changing job on the first day, but they see it when the cash flow deteriorates in terms of the income coming into the account. Maybe that's a good explanation for that, but the bank, if it's an alert situation, must see this situation as early as possible as a potential warning trigger and manage that accordingly. Because at the same time, if suddenly the revolving credits, the utilization rate is increased from, let's say, normally it's 5-10%, now it's 80 to 85% because the credit card is now paying for the bills in the household. That can become an unstable situation in the long term. So again, that's a trigger to take into account. These data triggers often go into an early warning score. So if the score is high or low, the bank can use that profile of the customer to set the thresholds of when to do certain activities, and we'll also come back to that. And then also the number of delinquencies over time. More number of delinquencies, more days past due than historically seen by the bank. And this type of information is important to use by a bank in really to automate some processes that can be used either by the case handler working with Jens, or automatically triggering SMS or message to Jens through NetBank or other type of communication channels.
But can I ask a question about the early warning score, and maybe it's for you, Buse. Why is that relevant versus other type of PD models like the standard behavior model? Or
Very
standard behavior
good question.
Yeah.
Exactly.
Yeah.
So generally, this is another topic we are facing a lot, because in the banks or in telcos, in organizations, there is generally an application scorecard and a behavioral scorecard. And behavioral scorecard is good to see the payment behaviors, how they are behaving in the payments. However, early warning scores are slightly different than behavioral models. For example, from target definition, behavior model is measuring if there will be any days past due, 90 plus days past due in the next 1 year. However, early warning models needs to be more time sensitive. They should predict the shorter term, not like 90 days past due in the next 12 months, but instead generally to predict if the 0 days past due clients, so fully healthy payers, if they will be struggling and having a 30 days past due in the next 3 to 6 months, not waiting for 12 months, because the goal of the early warning score is to take an action in a very short time when there's an alerted life-changing situation in our customers. So first of all, the target definition and the performance period is different. So in analytics, we take care of these two aspects in the model developments. And also the targets are different. So when we create the development samples, behavior models are developed on any existing customer sets, but the early warning models are starting with the non-delinquent or very healthy 0 days past due customers. So we are trying to take them as starting point and then measure if they will go in a struggling phase or not. So this is also another difference in between them. The last one is the model variables. Generally, they look similar, as you also can see in the slide. So past delinquency behavior, limit or risk usage are the common areas. But in early warning models, we use more trended variables. Jacob, you mentioned the credit utilization rates. If in the last 1-2 months, if you started to spend with your credit card so harsh, it can show that you are in short with cash and you are trying to find some finance in your personal life. So these are the main differences, and early warning scores are better working in this spotting the trouble in time.
And just to put it into life, if we move to the next slide, I think the segmentation is the next step in this space, because we have done some projects together, Buse, in this space. And just to give the audience a visual view on how a strategy can look like in terms of managing vulnerable customers, it's really to categorize customers in segments. And that is not a trivial activity, but it requires thorough work with data analytics to make sure that the bank has the right grouping and segmentations of the customers. And I'd like to ask you, Buse, because then we have, in this example, we have a personalized action route, but that is defined based on risk. Maybe you can just quickly elaborate, how do we actually get to that result?
Yeah, exactly. Thanks for the curveball, Jacob, because as you can see in the visual in the screen, so there is a score-based action route definition. So this VLR, LR means very low risk, medium low risk, or medium high risk. So very different categorization. And it is depending on the data analysis. It's looking a bit complicated. I won't walk through you every detail, but just to give a flavor of how we run this data-driven analysis. So first we are checking the PD values or score levels of our clients and put it in a dimension with their balance at risk look. So trying to understand different categories in the portfolio. And then we are checking what is the likelihood of these customers in each band to move towards the worst risk bucket. So which means that if they are starting from 0 days past due, what is the likelihood of being 30 DPD? If they are already in 30 days past due, what is the likelihood into 60 DPD? So it is going like this. And then some expert and business judgment also applied on top. You can see the coloring, the green ones meaning low risk, amber is medium risk, and red is high risk. And we are also balancing these percentages. So how to put the cutoff so that we are not defining everyone in high risk, because your people, your FTEs can't handle maybe thousands cases in one day. So we should be also mindful about the workload. So just an example, we have this high risk categories you can see with the blue arrow, and it is only representing 6.5% of the total portfolio. So they are high risk, but also they are a very limited number of cases you need to handle, but they have a very high likelihood to go into the worst bucket. So 45% probability that they will go into the next worst bucket. So we are using data and analytics in order to segment the customers and personalizing the action routes. Maybe one step forward. In the previous one, you have seen how we are doing the segmentation with data, triggers, and analytics. But it is also important also from business perspective, but regulatory perspective, how to personalize these actions. So what does it mean? We put different segments. It means that one of the group requires a different treatment and the other requires a different. So if it is just medium risk, then maybe not to push them with a direct phone call, but start with SMS and mobile app pushes. However, if it's a higher risk, maybe more frequent touch points with the customers. So it is changing also in your actions, and you can define it in your platform, in your system, to automate all these actions.
So just to summarize a bit, so we speak about data, we speak about data points, we speak about scorecards, we speak about early warning scores, we speak about segmentation, and we speak about software. So can you in some way put into context for me, how does that work with the unified platform approach?
Very relevant question, Bo. Thank you. So unified platform and the modern platform is key, because what we have discussed, data-driven analysis, which means that you need to have access to data. And as analytics team, you need to be able to play with this data and prove the data-driven approach to select the right early warning triggers, not to disturb any customers, because they wouldn't, it wouldn't mean that they are struggling. So we should ensure also with data, but also with expert judgment, that this is a relevant trigger, this is a relevant scorecard, which means that we need a sandbox for model development to identify these triggers properly. But also in real life, we all face that if you have a scorecard or a model trigger, it's not sometimes easy to turn it into your decision engine, because it takes a lot of time for IT teams to get it into the priority list and implement into the decision engine. So in this concept, you need to be also agile and update your strategies, which is key to have a unified platform where you have data, model development environment, and also a deployment process which is very user-friendly and seamless. It can be done without waiting so many months in the lists, and then integrate it into your decision engine and put into production in a couple of days or weeks maximum, not to wait months to have this new strategy to be tested and go live. So a unified platform can reply to these needs in the organizations to capture the vulnerable customers on time.
That's a great answer, Pusa, and maybe I can also get some help from you, Jacob, around this. So how do we approach with our unified platform, and what is the last message that you want the audience to listen to today?
Well, I think that's a great question, Bo, and let me start by answering by looking into how our studio looks like, because we've talked about the unified platform. Historically, Experian has done a lot of different software products across the customer lifecycle. This is not new to us. We've done it for 30 plus years, but historically it's been very individual software components that required API connections. Then 10, 12 years ago, we created the PowerCurve platform that connected that into one platform, but that was more the credit decision part. But now we combine it with data, the deployment of the models into the decision engine category. And that's really important to really, the key message is simplify the process, enhance the collaboration between the different parts of the organization, is creating the opportunity to get value out of data much more quickly than before.
Okay, that's clear and a good way to end the session. So we've seen today how the right data strategy and the modern technology platform can actually transform customer management activities and help you identify trouble before it hits your bottom line. So I hope and we hope that you found this session insightful and helpful. And I would also, add a little commercial break or whatever we should call it here. The next and final session of the series will summarize on the first 4 sessions how a modern platform creates value across the customer lifecycle. Feel free to reach out to me or to Jacob or Buse around any of the topics that we have discussed today. Always here to help. So yeah. And last but not least, the QR code is still there. If you want the Forrester report and if you want to get it, you can do it by using the QR code. It will be there for a few seconds more. So yeah, get it while it's here. And again, thanks to Buse and Jacob for a lot of helpful insight. Really, really much appreciated. Thank you.
Thank you.
Thank you.